Dinar shift. Let's address a topic that is front and center for everyone holding Iraqi dinar, the specter of heavy taxation following a potential currency revaluation. This is not a conversation driven by fear, but rather by the necessity of informed, practical preparation for a moment many have anticipated for years. For individuals who have followed the dinar story, the idea of a significant exchange rate adjustment, often referred to as a revaluation or RV, represents a potentially life-altering financial event. Yet, with any substantial creation of new wealth, governments around the world are fundamentally obligated to examine the fiscal implications, and this scrutiny inevitably involves taxation. Our focus today is on understanding the frameworks and strategies that could determine how much of a potential financial uplift you may be able to retain, ensuring you are ready to act strategically, not react emotionally when the time comes. The concept of a revaluation, where the Iraqi dinar's value against major world currencies changes dramatically, has been a dominant theme in this community. It's an unusual financial scenario, rooted in the potential for a developing economy to reset its currency based on improving stability and resource wealth. However, as this speculation has grown and the holder base has expanded globally, it has drawn the attention of various international fiscal authorities. When a sudden, large-scale event is expected to generate significant gains for a wide number of citizens, tax frameworks are almost guaranteed to be applied. These taxes can encompass several categories, most commonly including capital gains tax on the profit realized from the sale of the asset, and foreign asset reporting requirements that mandate the disclosure of large holdings or transactions outside your home country. Understanding these dual layers of taxation and reporting is the first crucial step toward financial protection. Why exactly are heavy taxes a realistic consideration in this context? The answer lies in the massive scale of the anticipated wealth transfer. Unlike the steady, incremental gains seen in typical market movements, a rapid revaluation would, theoretically, convert substantial amounts of low-value currency into high-value currency almost instantaneously. Governments view such large, sudden transfers of wealth as a legitimate and necessary source of revenue. This is a standard fiscal mechanism applied to profits from assets like stocks, bonds, real estate, and digital currencies. What elevates the dinar situation's sensitivity is the sheer volume of speculation and the widespread expectation of immense returns across a diverse global holder base. Authorities are fully aware of this speculative environment, which is why early indicators point toward potentially stringent tax enforcement. Unprepared holders, particularly those expecting a tax-free windfall, could face significant and unexpected reductions in their net proceeds. The good news, however, is that while tax obligations are real and must be met, they do not have to consume the majority of a realized gain. Effective preparation and a forward-looking strategy can legally and ethically preserve a much larger portion of your wealth. One of the most impactful strategies involves timing and structuring your cash-out processes. Many people operate under the assumption that the tax rules are static, but in the immediate aftermath of a major financial event like a revaluation, there is often a period where regulatory clarity is still developing. This early window, while potentially short-lived, can offer unique strategic options. Authorities are quick to react, and stricter, less flexible tax rules often follow the initial wave of high-volume transactions. Therefore, the principle of timing is far more critical than many realize. Rushing to convert a massive holding immediately after the event, especially during a period of intense public and regulatory focus, could expose the entire gain to the highest applicable tax brackets. A more considered, phased approach, where transactions are broken down into smaller, strategically timed steps, might offer pathways to mitigate the overall tax liability. This strategic patience is key. It is not about avoidance, but about smart, planned engagement with the tax system. Emotional reactions driven by excitement or fear often lead to rushed decisions that can result in maximum tax capture by the authorities, costing the holder significantly more in the long run. Another cornerstone of effective financial preparedness is securing the guidance of a qualified tax professional. For many, the cost of an initial consultation or retainer feels prohibitive, but this is a false economy. A few $100 or $1,000 spent on expert advice today could translate into tens or even hundreds of thousands of dollars saved tomorrow. A professional who specializes in international and domestic tax law, particularly involving foreign currency gains, possesses the necessary knowledge of deductions, reporting methods, timeline considerations, and legal structuring that an ordinary individual simply does not have. Their expertise is invaluable in navigating the complex regulatory environment, The critical value they provide includes determining how your gains will be classified, for example, whether they will be treated as ordinary income, which is often taxed at the highest rates, or as capital gains, which may qualify for lower long-term rates. Furthermore, they can clarify the intricate requirements for reporting assets held across different jurisdictions, helping you establish a documented and compliant financial position before the revaluation occurs. In an event as complex and potentially high stakes as a major currency revaluation, professional guidance transcends mere luxury. It becomes a fundamental requirement for safeguarding the wealth you hope to realize. Their strategic input minimizes the risk of penalties, audits, and unnecessary financial stress. Beyond professional consultation, diversifying your assets plays a substantial role in shielding your overall wealth. It is a common psychological tendency for dinar holders to place an almost singular focus on this one asset, anticipating a single, massive payout as the solution to all financial concerns. While this focus is understandable, relying entirely on one asset exposes you directly and acutely to any specific, heavy tax regime levied against that asset. If a strict, high-percentage tax is imposed specifically on realized dinar gains, all of your wealth is immediately impacted. This is a point of vulnerability that a diversified portfolio can address effectively by strategically allocating a portion of your wealth into other asset classes, such as real estate, established, stock market indices, precious metals, or even other stable foreign currencies. You create multiple independent layers of financial security. Should the taxation of dinar gains prove to be exceptionally high, these other assets serve as a critical counterbalance, helping to stabilize your overall net worth. Furthermore, diversification introduces essential flexibility. As tax laws are subject to change, a spread-out portfolio allows for easier adjustments to your total financial plan, preventing you from being entirely captive to the rules governing a single currency or asset class. It is the financial equivalent of having multiple uncrowded avenues of exit, rather than being confined to a single, potentially bottlenecked route. A significant psychological factor to manage in this process is the pervasive tendency toward panic. When news of impending or potential heavy taxation breaks, the immediate reaction for many investors is to panic, leading to hasty and ill-considered decisions. This emotional reaction, fueled by a lack of clarity and fear of loss, is often exactly what authorities rely on, as rushed actions increase the likelihood of procedural mistakes that lead to higher tax revenue collection or penalties. Protecting your financial outcome requires a steadfast commitment to remaining calm, rejecting knee-jerk reactions, and thinking several steps ahead. You must view the revaluation process not as a sprint to be won by the fastest, but as a sophisticated, long-term strategic endeavor. The correct mindset is hat of a disciplined planner, not a gambler. Treat the RV like a complex game of strategy, where every move must be intentional, well-researched, and aligned with your broader financial objectives. Smart investors execute their preparations quietly, rely only on verifiable facts and accurate information, and refuse to let sudden market noise or unverified rumors push them into actions that could compromise their long-term future. This emotional control is, in itself, one of the most powerful safeguards against unnecessary financial losses and the imposition of maximum tax burdens. Let's delve deeper into the critical element of timing once more, as it pertains to early mover advantage. Should a revaluation event unfold rapidly, there is a theoretical temporary window of opportunity, potentially quite brief, where the necessary legislative and regulatory machinery for comprehensive, highly restrictive taxation may not yet be fully operational or defined. Those individuals who are not only well-informed, but also fully prepared to execute a defined strategy might be positioned to act faster and with greater confidence within this fluid period. This advantage underscores the importance of continuous and diligent monitoring. Staying actively engaged with credible news sources, scrutinizing official government communications, both domestic and international, and setting up alerts for regulatory changes are not optional activities, they are essential defensive measures. Your ability to swiftly and accurately respond to these early developments could be the differentiator that prevents your entire conversion from falling squarely into the highest tax brackets, an outcome that could severely diminish your net proceeds. The prepared holder can potentially benefit from less restrictive initial rules, while the late or uninformed mover risks facing a much heavier financial imposition. A separate yet equally critical consideration involves the meticulous process of fulfilling all official reporting requirements. It is often overlooked that substantial financial losses do not exclusively arise from high tax rates, they frequently result from the failure to correctly file paperwork, meet disclosure deadlines, or properly document the underlying transaction. A single omitted form or procedural error can inadvertently trigger costly penalties, a full tax audit, and significant administrative stress that can drag on for years. Many jurisdictions impose rules that require the reporting of significant foreign currency holdings or major foreign transactions even before the actual conversion takes place. Furthermore, authorities universally demand detailed and ironclad documentation that proves the initial purchase date, the total amount acquired, and the specific exchange rate value at the time of purchase. If a holder is unable to produce this clear, verifiable evidence, the tax authority may resort to making assumptions about the cost basis. Assumptions, which nearly always lead to a higher taxable gain and, consequently, a larger tax bill. To mitigate this risk, every single purchase receipt, transaction record, bank statement, and note must be diligently archived. These records are not mere paperwork. They are your legal shield when engaging with major financial and government entities. For those with substantial holdings, the use of legal structures represents an advanced and highly effective strategy for protecting wealth from potentially heavy taxation. High-level investors often utilize sophisticated vehicles, such as specialized trusts, limited liability companies, LLCs, or other corporate entities to legally hold foreign currency assets. These structures are not about avoiding taxes illegally. They are legitimate tools designed to offer specific tax advantages, enhanced asset protection, and greater multi-generational control over the timing and manner in which funds are released. For instance, an LLC structure, depending on the laws of the operating jurisdiction, might permit the classification of gains in a way that minimizes the tax burden, while a well-established trust can provide significant long-term estate planning and tax deferral benefits. Critically, these legal arrangements require professional, expert guidance to be set up correctly and must adhere to all applicable national and international laws. Attempting to establish these structures after a revaluation event may be too late or even disallowed. Having them properly established and funded before the event takes place puts the holder in a substantially stronger and more legally protected financial position. It is also vital to maintain an awareness of the inherent fluidity of tax legislation. The legal and regulatory landscape is rarely static, and what is being discussed or rumored today may undergo fundamental changes once a major economic event, such as a currency revaluation, actually materializes. Governments continually adjust tax codes based on real-world factors like public reaction, shifting economic conditions, and the actual volume and scale of transactions that occur. This means that a rigid, one-size-fits-all financial plan is inherently risky. Successful preparation requires a commitment to flexibility and routine reevaluation. You must maintain an up-to-date awareness of new government decrees, legislative proposals, and economic shifts, and be prepared to modify your strategy in response to verified, new information. Remaining informed, reviewing your tax strategy periodically with your professional advisor, and cultivating the capacity to adapt are essential defensive measures for keeping your financial position. In this complex environment, knowledge serves not only as power, but as an active and dynamic form of long-term financial protection. The importance of mindset and emotional discipline cannot be overstated. A significant number of dinar holders perceive their investment as a mere lottery ticket, expecting an instantaneous, simple solution to all financial woes. However, genuine, enduring financial success demands discipline, calculated patience, and a high degree of emotional control. You will inevitably be bombarded by a constant stream of rumors, extravagant hype, and unverified predictions from countless sources. Reacting to every unsubstantiated claim will only create confusion and erode your confidence in a measured plan. The most effective protection against the potential bite of heavy taxation begins with controlling your own emotions. True confidence in a high-stakes scenario is derived from thorough preparation, not from a state of panic or overexcitement. The successful investor adheres strictly to their predetermined strategy, makes adjustments only when confronted with verified, factual information, and maintains a long-term perspective. Short-term excitement often leads to costly, regrettable errors, while methodical, long-term thinking is the proven path to preserving significant wealth. A more sophisticated, geographically aware consideration involves the strategy of spreading out cash outs across different banking systems, but this must be approached with extreme legal caution, and only after consultation with an international tax expert. Some investors explore international banking relationships to potentially leverage more favorable regulations or lower tax rates available in different sovereign jurisdictions. This is emphatically not about evading tax obligations or breaking any laws. Instead, it is a legal strategy rooted in the recognition that every nation maintains its own distinct set of financial rules. Exploring international avenues, where legally permitted, could potentially offer beneficial regulatory or tax environments, but every action must be entirely lawful, transparent, and thoroughly documented to avoid severe legal and financial repercussions. For those who already possess established international banking access, this may be a pathway worth exploring under strict professional supervision. You may understandably be concerned about the practical percentage impact of heavy taxes. While the actual rates are subject to massive variation based on the holder's country of residence, their overall income level, and the specific classification of the gain, ordinary income versus capital gains, estimates frequently range from 20% to over 40% of the profit realized. For a substantial gain, even the lower end of this range represents a significant reduction in take-home funds. This sobering range underscores why meticulous financial planning is not merely optional, it is a fundamental necessity. Even if these percentages feel daunting, a well-executed plan can legally and strategically shield a far greater portion of your profit from being lost to maximum taxation or unnecessary penalties. The difference between 20% and 40% on a major transaction can amount to hundreds of thousands of dollars, making proactive preparation the single most profitable action a dinar holder can take today. Another crucial, yet often overlooked preventative measure is the importance of controlling your digital and online footprint. In the modern era, individuals frequently overshare intimate financial details on social media and public forums without considering the permanent negative consequences. Posting projected gain figures, sharing screenshots of large currency holdings, or boasting about potential wealth can attract deeply unwanted attention, not only from opportunistic individuals but critically from tax authorities and regulatory bodies who actively monitor public financial chatter. The core principle here is to adopt a rigorous policy of financial privacy. This privacy is not about secrecy, it is a strategic form of protection. The less you broadcast about your specific financial standing, the more securely you maintain control over your own narrative, and the less information you willingly provide to potential auditors or inquisitive government agencies. A private, measured approach is demonstrably safer than a public, boastful one. An additional strategy, which aligns with both ethical considerations and fiscal efficiency, is exploring the possibility of charitable giving. Depending on the tax laws in your country, donating a well-defined portion of your eventual realized gains to a qualified charity may offer meaningful tax deductions. This mechanism can legally reduce your overall taxable income, thereby lowering your final tax obligation, while simultaneously channeling funds toward causes you value. While this option is certainly not a universal fit for every investor, it is a worthwhile discussion point with a tax professional if it aligns with your personal values and long-term financial goals. Many find this dual-benefit approach, supporting others while increasing tax efficiency, to be a rewarding and powerful element of their overall financial plan, turning a portion of their gain into a strategic, philanthropic endeavor. We must also acknowledge and prepare for the inherent emotional stress that accompanies an event of this magnitude. The anticipation of a revaluation, compounded by the pressure of tax planning, strict timing requirements, mountain of paperwork, and the complexity of legal structures, is enough to create significant anxiety for Enyo. It is easy to feel overwhelmed, nervous, or unsure of the next step. However, the act of preparation is the most effective antidote to this stress. You do not have to know every answer instantly, but by breaking down the complex challenge into manageable sequential steps, consulting a lawyer, organizing documents, making a phased plan, you regain a crucial sense of control. This active pursuit of control transforms stress into manageable responsibility. The revaluation brings both immense opportunity and significant responsibility. The ability to successfully manage both is the ultimate measure of long-term financial success. To consolidate this comprehensive preparation strategy, it is vital to be aware of the key actions to avoid. Do not rush the process. Do not make any financial decision based on an unverified, sensationalized rumor. Avoid the temptation to take high-risk, unproven steps promoted by unverified individuals or groups. Absolutely avoid panic selling or purchasing under duress. And, most importantly, never skip the required paperwork or ignore a tax law. Each of these missteps carries a potential cost that can far exceed the burden of heavy taxes alone. The most robust and successful approach is one built on calm, calculated planning followed by informed, precise action. Your essential protective strategy must therefore integrate several non-negotiable pillars. Meticulously plan the timing and size of your potential cash-out transactions. Immediately consult with specialized legal and tax professionals. Create and maintain an exhaustive archive of all purchase and transaction records. Proactively explore the appropriate legal holding structures. Wisely diversify your overall asset portfolio, maintain an active watch on all relevant changing tax laws, and strictly protect your personal financial privacy. These individual steps, when executed together, form an interconnected defense designed to help you legally retain the maximum possible portion of your gain, rather than losing it to unforeseen heavy taxes, avoidable penalties, or procedural errors. While this level of preparation demands significant time and focused attention, the resulting security and financial retention make the effort unequivocally worthwhile. The revaluation event represents a major opportunity, but with that opportunity comes a fundamental responsibility to protect what you stand to gain. Protecting your potential wealth now is the single greatest action you can take to alleviate fear and ensure clarity when the actual moment of revaluation arrives. History demonstrates that the most successful investors are rarely the ones who move the fastest. They are consistently the ones who are the most thoroughly and methodically prepared. Your ultimate financial outcome is not solely dependent on the revaluation itself, but overwhelmingly on the sophistication, discipline, and emotional control with which you manage the process that follows. Stay strategically informed, remain disciplined, maintain an unwavering focus on your long-term plan, and consciously prevent fleeting excitement or fear from leading you to costly mistakes. Preparation is your single most potent financial advantage. With the correct, legally sound approach, you can navigate the complex tax environment, protect your realized gains, and establish a foundation for genuine, enduring financial security.